Hey guys, it's Nick. Now, most people spend a lot of time planning on how they're going to make money, but they spend very little time planning how to maximize the money that they keep. In this video, I'm going to talk about the different types of income that you can make and the different type of tax rates that are applied to them. I'm also going to show you how to pay zero tax legally on up to almost $53,000 as a single person or almost $106,000 as a married couple. Now, this is not a gimmick, it's a real thing. However, you need to have a good chunk of money to do this to maximize to these levels where you're getting $53,000 or $106,000 tax-free. But you can still use these techniques even if you have less money and are building up to that level in the hopes that one day you will live completely off of dividends and capital gains and not really work anymore. So let's get into how all of this really works. So here is the 2021 federal income tax bracket and rates for single filers, married couples, and heads of households. I'm going to focus on the individuals. You can take these numbers and just double them for married couples. Now, most people know these as the tax rate for the income you get from a job, but they actually also apply to other types of investments. But let's just look at this. There's a 10% tax rate from zero all the way up to $9,950. And the 12% tax rate goes from that up to $40,000 and change. So how do you pay zero taxes when there's a 10% tax rate from zero up to 10 grand? Well, let's go down here. And this is the standard deduction that you can use as a single filer. That's $12,550. So what that means is if you worked in McDonald's or whatever and made $12,550 for the year, you would fall into this tax bracket. However, this standard deduction would wipe out that income and the IRS would see you as having zero income and therefore zero tax on that amount or lower. Now, this is the 2021 capital gains tax rates, and this also is the tax rates for qualified dividends. And so you see there's actually a 0% tax bracket for income for singles up to $40,400. So the 15% tax rate kicks in above $40,400, which means if you have capital gains or qualified dividends, $40,400 or under as a single person, you pay zero tax. And if you're a married couple, that number could be $80,800 together that you will pay zero tax on. So let's look at this situation in graphical form. Again, this is for the single filer. If you're married, you can just double these numbers here. And so what this means is there's two kinds of income according to the IRS. There is these regular green dollars, which is qualified dividends and capital gains according to the IRS. And then there are these kind of purple dollars that are ordinary dividends, short-term gains, salary, interest, and REITs. And so the gist of this whole technique is to limit your qualified dividends and capital gains together combined to no more than $40,400 in a calendar year, and to limit the combined value of these categories to no more than $12,550 in a calendar year. So now people are going to say, well, how could I do that? Because I want to invest in REITs, or I want to get interest from bonds or CDs or something like that, or I have short-term gains in the stock trades that I do that I don't hold for over a year, or sometimes I have ordinary dividends. So there's a way to limit these categories down to $12,550 if you try. And the way to do that is to keep these types of investments in tax sheltered accounts, which are 401ks, IRAs, and Roth IRAs. So REITs do not pay dividends, they pay distributions, which are considered regular income. Interest, like from a bank or a CD or a bond fund, is also considered regular interest. Salary, you can't really control because you either have a job that pays you over that or not. Short-term gains, if you're doing a lot of short-term trading, keep it in your IRA or Roth IRA. Ordinary dividends, You can avoid getting categorized as having ordinary dividends if you hold the stock past the holding period that the IRS talks about, or to make sure that you buy American or foreign company stocks that trade on a US exchange. It's a little bit involved and may be the subject of another video of the difference between ordinary and qualified dividends. But that's how you can kind of move these categories into places where you do not get taxed, and therefore you can limit this amount to $12,550. On this side, there's not a lot you can do to reduce your qualified dividends because they get paid out if you're holding the stock, whereas your capital gains, you have some room to play on that because you do not have to realize your capital gains every calendar year. So if you have a certain amount of qualified dividends and you don't want to go over the 40,400, you can wait till the next year to sell a stock to get the capital gains for the next year so that you don't go over this amount. So let's see what that looks like. I like to think of it as filling up 2 cups of water or 2 buckets or whatever you want to call it. So on the one hand, the bigger cup is the 40,400, where you just want to fill up with capital gains, long-term capital gains, and qualified dividends. And if you don't know, a capital gain is a gain from a stock or investment that you held over 1 year. If you don't hold it for over 1 year, it is considered a short-term gain and subject to regular income tax rates. Same with a qualified dividend. A qualified dividend, there's a whole bunch of rules that the IRS lays out for what a qualified dividend is. But basically, you cannot buy a stock a few days before the dividend is paid out or the ex-dividend date and then get the dividend and then sell it, a few days later. There's a holding period that you have to have. And so I recommend you hold any stock that you buy for dividends way past that holding period so that they are not considered an ordinary dividend and taxed at the regular income tax rate. This is something you want to avoid. So what you would do is every year, you can't control your qualified dividends really unless you sell the stock. But let's say you're holding long-term for the dividends. So let's say you have $30,000 worth of qualified dividends during the year, and you have room for 10,400 more. Well, what you would do is you would sell some of your stock, even if you didn't want to. You can sell up to $10,400 of stock that has a capital gain. You bought $100,000 worth of Microsoft and now it's worth $110,000. You can sell that Microsoft stock and put the gain in here, right, for the year. And then you can go right back and buy that stock back at the new price. And you have now filled up this cup so that all of the gains are now being used in this year and none of it is wasted. And then the gains next year, you'll worry about those next year. Same with this smaller cup. If you have some kind of salary, hopefully it's under $12,550, you put it in there. Let's say this is $5,000. And so you would limit your short-term gains. If you have some short-term gains, then you would definitely want to offset that by realizing any kind of losses that you have within the year that are short-term. And that's a good technique to use because generally stocks that are losing money at the end of the year are going to continue losing money. So you're better off getting rid of them and netting them out with your short-term gains so you can limit the amount of short-term gains you have. And like I said, with ordinary dividends, hold the stock longer so that they become qualified dividends so you don't have this problem. Interest like bonds or CDs, put them in an IRA, and the same with REITs. Now, if you do not have enough to fill this 12,550 up, you can buy some REITs or something in here as long as you plan it right so that they just fill up this 12,550. You don't want to end the year, if you have enough money, with these cups not filled up as much as possible, because then you are kind of leaving money on the table. And so if you do it right, you can fill up these cups right up to their levels just about, so that you maximize the amount of tax-free income you receive each year. So guys, that's a look on how to legally not pay any income tax on up to $53,000 for a single person and up to $106,000 for a married couple. Now, of course, that is only for federal taxes. If you live in a state that has an income tax, you will get taxed on those amounts regardless. So if this is your plan going forward, you might want to consider moving into a state that has no state income tax, like Washington, Texas, Florida, Nevada, and a few other ones. Now, just to be clear, you need a good chunk of money to be able to do this. So assuming like a 4% dividend rate, to get like $53,000 a year in dividends, you need like $1.3 million to do that. So it's going to take some money. But the good news is that you don't have to do the $53,000 from the beginning. It's something you can build up to. So even if you're making 10 or 15 or 20, 25,000 in dividends and capital gains tax free, that's still pretty good. So if you want to do this technique, you got to have patience and build for the long term. I'm having kind of a hard time doing it because I have a hard time holding onto a stock for longer than a year. So that's a bit of a problem that I'm working on for myself to do this. If you like this video, hit the thumbs up. And if you want to see more videos about the difference between qualified dividends and ordinary dividends and things like that, let me know in the comments below. Thanks for watching, guys, and I'll see you in the next one.